Hello traders, this is the first weekend video, the bigger picture one, in which I'm going to go through daily and weekly charts and again compare DAX with the US indices. So we are looking as always at the DAX index daily chart, zoomed in into this 3.5 soon to be 4 month of consolidation. And if we take a look at the calendar, we can see that in September there is only, let's say, 1.5 weeks left. And the speculation on August 31st was that markets are entering into September, which was historically the worst month for S&P and one of the two worst months for DAX, and yet only DAX made a pullback while US markets, while DAX was here trapped basically inside a multi-day range, had a series of higher highs, marching higher, and basically printing all-time highs every other day. Now the rally there is a broad market, since all of them printed all-time highs, including Russell 2000, a small cap index. And as far as DAX goes, these were the first 2 days of September, Labor Day, and then September the 2nd, the trend down day. And as we can see, we are still trading inside that trend down day from this September the 2nd with no downside follow through. There was an explanation in the past morning notes and in the recap videos what downside follow through means. And in case of daily charts, a close like we had on a Tuesday below support is only a start. Then it requires lower close and lower lows. What we got on Wednesday was marginal lower low without a lower close, and then market went back inside the former range. This kind of move was after the FOMC. This was the Wednesday with the FOMC in the evening, and DAX decided to follow the US markets or to make a catch-up move. So the question is now, obviously, since those US markets are printing all-time highs and DAX is back inside the range, can it follow them and continue toward its own all-time high? And the bias and the thinking and bigger picture basically from Monday is going to be the same like on Friday, meaning as long as they are above this new gap. We had a gap up and go day on Thursday when they decided to follow US markets, and as long as they're above that, we can expect buyers on dips. Now on Friday, a market pushed into the daily 20, poke a bit above, went down, we got a momentum shift, and they ended their down move around 23,600, which was emphasized for a few days as a location with the biggest option interests for both calls and puts. And the option market makers and big institutions that are major option sellers, they want obviously majority of options to expire worthless so they could keep entire premiums, and they managed to do that on Friday as well by keeping the price around the OPEX auction right around 23,600. So that was the story about the Friday, and the bigger story here is that on the way up, when market tests some former support, now resistance, like for example daily 20, which held the price here and here and here, and in many other occasions, that it can obviously act as resistance. If they push higher, then daily 50 can act as resistance, like it was acting here and as support. And if we scroll down, it was a support here. Then in many other occasions, DAX is a old school instrument like the S&P, and they like to react from those usual industry standard moving averages, and those are the ones here from this chart. Those simple moving averages, daily 20 being the midpoint of daily Bollinger Band, and then widely in use, daily 50 and daily 200. When market goes below daily 50 and starts to move down toward daily 200, you can bet that that kind of space can hold the price for a long period of time. And here we had some days trading inside. So here, these are 13 days after a trend down day in which market didn't make any kind of downside follow through. So now the question is this pattern which we had here with this push back inside the range, is all of this just a false break below August low? And is this what market made on Wednesday, OPEX swing low? Because it can be if, again, market is holding now this point. Holding this point, holding this gap means that if they fill the gap, that's it. For a long scenario, for bullish scenario, what market could do, and that should be the absolute minimum allowed pullback for the bullish scenario, would be something like this. Like, okay, they filled the gap, but then they pushed higher. And for the bearish scenario, market need to find acceptance again below March double top, and then you see where the breakdown arrow is, below Wednesday low, which was a spring below August low. So those are our scenarios for the next period. And again, going into September, we had that speculation about some down moves, and we also had behind our back Jackson Hole Symposium chart, which indicated that dip producing effect was five out of the 5 times in the previous 5 years. And we got that dip in this year as well, but only on DAX. We didn't get it on the S&P, and the S&P, Nasdaq and other US markets completely shrugged that statistic, both about September and about potential dip after Jackson Hole Symposium. So there is still a very big lack of correlation between the markets. And when we go higher on a DAX index weekly chart, you can hardly find the more boring chart than this one. Why I'm saying that? Because I made those labels, no upside follow through and no downside follow through, weeks and weeks ago. And guess what? There is still no upside follow through and there is still no downside follow through. And we are here for 3.5 months. However, everybody who is with this service for many years can vividly remember much bigger consolidation than this. So yes, this consolidation, it takes time. And you see a weekly close, for example. So weekly close is above very important level on March double top. Bigger consolidations were before. This would be something same size, and then I think everybody who traded this period can remember this here. This was 11-month consolidation, 11-month, and the majority of that would be here in this box, let's say like this. What is the difference here? The difference is that this box here, you see the lines here, and you can see by these numbers that this is a 1,000-point wide range. Inside that 1,000-point wide range, we have that smaller range, and that would be this one here, which was our former 9-day consolidation between these two levels. And here there is around 400 points. So this is a 400-point range inside 1,000-point range, while here, back to that weekly chart, so that would be 1,000 point here, visible on a weekly chart, while this here was 1,200 points. Now that doesn't really sound like something that's much bigger than 1,000 point, and maybe you could ask, okay, but who's going to guarantee that now we are not going to be in that kind of range for 6, 7, 8 months? The difference is quite big actually, because 1,000 point in this period is not the same like 1,000 point now. Now think about it. 1,000 point equals 1,000 points, right? But here, 1000 point on these prices is 7%, while here on these prices is 4% only. So it is not the same, it's absolutely not the same, and we shouldn't think in absolute values, we should think in percentage. So if market can be trapped in 7% range, and if we include these spikes here, it is then bigger, it's like 8 to 9% for months. Can it be trapped in 4%, which is basically, just half of that previous one? And I think the answer is no, because US markets are keep pushing higher. And sooner than later, DAX is either going to follow them, or they are going to start to make a dip, and then DAX, which is already in range, could then follow to the downside. But for now, what they are doing for now is this. This is Russell. And as we can see here, they made a double top from their all-time high in 2021. They made a double top in 2024. This is November, this is November. So 3 years later, they are here, they go down again. Now, they are here, there again with the new all-time high, and came there from the position of higher low. Now, there is a bigger chance that they could actually break and continue higher. This is now the market to watch on the US markets. This, the junk, the Russell small cap index. Going to other markets, Dow, new all-time high, very solid candle, and I'll just observe the differences here between the weekly candle on DAX, weekly candle on Dow, weekly candle on Nasdaq. Very solid one, 3 weeks in a row, strong upside trend, while this is sideways neutral, marginal lower lows, no downside follow through. And then S&P, which made a breakout last week from the 4-week balance, and this week was a continuation to the upside. So all of these US markets are bullish, and people across the social media are inventing highs there while they're still bullish. So if you don't have anything upstairs as a resistance, do not invent highs. Do not think that you can, for example, make technical analysis on a VIX chart the same like on these charts, which people do. I don't agree with that, because VIX is on its own. VIX is just a bunch of spikes. It cannot be the same like a stock or index. So all of that, yes, we can observe. But let's stick to the basis, and let's say, okay, these markets are still in strong uptrend, while DAX is still in the consolidation. And now, question remains, they are back inside the range. They are holding this gap. Gap wasn't tagged yesterday. Since the gap is the position of the gap, you see the lower end of a gap is right at the former support, which also acted as resistance here and here. So this is here in the bigger picture like an axis line. Therefore, that is increasing chances that this gap is actually going to be filled sooner or later. On that gap fill, you can bet that that's going to be a long, at least for a bounce, and then we shall see. So bear case is only below this gap, below the eye, and then below the arrow. Bullish case is above the eye and above. Now, daily 20 to be turned to support, then attacking daily 50 and pushing higher, making higher highs and higher lows. While inside this 9-day consolidation, we can still be neutral. Why? Because Rosh Hashanah is on Monday, and that saying, sell Rosh Hashanah, buy Yom Kippur, actually has some statistical background. Now, when we are speaking about statistics, like September is the worst month for the S&P, is it going to be the worst month every single year, like 100% of the time? No. Is sell Rosh Hashanah, buy Yom Kippur true 100% of the time? No. Is OPEX period responsible for every single swing high or swing low? Again, no. But in half of the cases on the OPEX, we do have swing highs or swing lows. For example, on June, we had a swing low. On July, we had nothing on OPEX, but on August, we had OPEX swing high. So when we do have statistics which are backed with years and years of research behind our back, then we need to account that in our speculation, but still charts and what we are seeing and what market is actually doing is first, and everything else is second, including economy, headlines, and all of this other stuff. Because it's very easy to form an opinion by reading some article. You need to form the opinion on chart. And for us, short-term traders, like day traders, swing traders, daily chart is the one from which we are seeking that kind of information about the context and potential trend. Is this range, this orange one here, is this really a place to take swing trades? That's the question. Because this here, this was gap up and go. Market didn't went inside and made a pullback here. So for us, for example, to attempt a swing long from March double top because it acted as axis line before. And that could be a trading idea. If market fills the gap, let's attempt then a swing long from there. While shorts, especially swing shorts, would require either much higher prices than this or again a breakdown, but this time with follow-through. So this was a breakdown, but it lacked follow-through. Once again, one candle closing below support, that's a start. Then next one and next days must prove that, and they didn't do anything here. We didn't get lower close. So now we are back in the range, and inside this range we can be for a while neutral. So that would be it about the bigger picture, and then the next video will cover a price action from Friday and a review of the week.